Welcome to the deep dive. Let's jump right in. The market's been, well, let's just say a bit of a roller coaster lately.
That's putting it mildly, yeah.
You know, inflation is still sticky. We've got tariffs floating around, that whole U.S.-China trade thing.
Mm-hmm.
It's definitely got investors feeling a little uneasy.
Understandably so. And you see it reflected in the S&P 500's performance.
Right, and I saw a stat from Bespoke Investment Group saying this is actually the roughest start to a presidential term for the S&P 500 since, get this, 1928.
Wow, 1928. That certainly puts it in perspective. It shows how much these broader economic issues are weighing on things.
But here's where it gets interesting. Amidst all this turbulence, a really quite rare signal has actually emerged from the S&P 500.
Okay.
And historically, this signal has been, well, surprisingly reliable. So our mission today is really to unpack this.
Mm-hmm.
What is this signal and what does its history potentially tell us about where stocks might be headed? Trying to give you, the listener, a useful lens maybe.
Absolutely, because looking past the daily noise at these sort of underlying participation trends, that can often give a clearer picture, you know.
Okay, so let's dig into that idea, market breadth. It's not just about the index going up or down, right? It's about how many stocks are actually moving with it.
Exactly. Think of it like, is the whole army advancing or just a few generals out front? Broad participation usually means a healthier move.
And Ryan Detrick over at Carson Group pointed something out recently. He said that in 6 of the last 10 trading days, something like 70% of stocks on the NYSE were advancing.
Yeah, that's a strong showing. 70% is a big number. It shows widespread buying, not just concentrated interest.
And he noted this has only happened, 7 times before in the last 75 years.
That's the really striking part, only 7 times in 3/4 of a century.
And each time before, his research suggests, it kind of marked a market bottom, followed by pretty decent gains.
That's what the historical pattern suggests, yes. A very compelling, though infrequent pattern.
Okay, compelling is right. But you hinted there might be something even rarer that just flashed.
Yes, indeed. And this one has a specific name. The Zweig Breadth Thrust, or ZBT for short.
The Zweig Breadth Thrust.
Developed by Marty Zweig, a well-known technician.
Yeah.
Basically, it measures the ratio of advancing stocks to declining stocks over a 10-day period, looking for a really rapid shift from very weak breadth to very strong breadth, a thrust, basically.
A sudden surge of buying power, essentially.
Exactly. A powerful, quick change in market character.
And the ZBT signal, it actually triggered reality.
It did on Thursday, April 24th, according to the data.
Okay, April 24th. Now, how rare are we talking here? You said the 70% thing was 7 times in 75 years?
This ZBT is even rarer. Including this latest instance, it's only the 20th time the signal has fired since 1943.
20th time.
Since World War II.
Pretty much, yeah. Over 80 years of market history. That alone makes you sit up and take notice.
Definitely. So, okay, it's rare. But why is it considered so significant? What's its track record like? This is the really attention-grabbing part. According to analysis, like from NDR using NYSE data, the Zweig Breadth Thrust has a perfect track record.
Perfect. As is.
As in, historically, it has predicted significant market gains over the following 6 to 12 months every single time it has occurred. Ryan Detrick put it bluntly on Twitter. 19 for 19 since WWIII.
19 for 19. Wow. So no misses in predicting gains over that medium term.
But according to that data set, yes. A flawless predictive record for positive returns in the 6-12-month window afterward.
Okay, that is quite something. So what kind of gains are we talking about on average after the signal?
The historical averages are pretty substantial. In the 6 months following a ZBT trigger, the S&P 500 has gained an average of 14.8%.
Almost 15% in 6 months. Okay.
And then looking out 12 months, the average gain climbs to 23.4%.
23% over a year. Those are definitely numbers that catch your eye.
They are. Very strong historical precedent.
Wow. Okay, so perfect record. Average gains of nearly 15% and over 23%. It sounds almost too good to be true. Makes you think it's smooth sailing from here. I assume there are some big buts or caveats.
Absolutely. And it's crucial we talk about those. History is a great guide, but it's never a guarantee, right?
Right.
So first off, this signal doesn't magically erase volatility. We could absolutely still see some, head fakes or pullbacks in the coming weeks or months.
Okay, so don't expect a straight line up.
Definitely not. The kind of choppiness we've experienced might well stick around for a bit. This signal is about the medium-term trend, say 6 to 12 months out.
That's a key point. The historical gains were measured over those longer periods, not necessarily starting the very next day.
Precisely. Short-term noise is still very possible, even probable. And remember the context. As of when our sources were written, the major indexes were still technically in correction territory.
Down 10% or more from their highs.
Right. So while the ZBT suggests a potential bottoming process and subsequent recovery, the immediate path could still be bumpy.
Okay, so given that context, the rare signal, the perfect history, but also the potential for ongoing volatility, how might someone listening, think about applying this?
Well, if you connect the dots, it could actually signal a potential opportunity.
How so?
If this historical pattern holds, and we are potentially near a significant market low point suggested by the ZBT, then this period where many good, solid companies might be trading at lower prices because of the recent pullback could be a favorable time to consider buying.
Okay. So the signal suggests underlying strength is building, potentially making current lower prices on quality stocks more attractive.
That's one interpretation, yes. It potentially aligns with that classic advice. Try to buy when there's fear, especially if there are underlying signs of strength emerging, like this breadth thrust.
It really underscores the idea of having a long-term perspective, doesn't it?
It absolutely does. Time in the market, not timing the market, right? That's historically been the winning strategy. This signal, if anything, reinforces that patience often pays off.
And, it makes me think about strategies like dollar cost averaging, just regularly putting money in, regardless of the ups and downs. Does that fit here?
It fits very well, actually, especially if you expect continued volatility but believe in the longer-term positive trend suggested by the ZBT. Dollar cost averaging helps you manage that choppiness. You buy more shares when prices dip, fewer when they rise. It smooths out your entry points.
Yeah, take some of the emotion out of it, too.
Exactly. And it helps you benefit from any recovery without having to perfectly pick the bottom.
And we should probably also just briefly touch on the very long-term picture. The stock market's average annual return, what is it, something like 10% over the last 50 years?
That's the rough historical average, yes. It's a good reminder that despite scary periods, the overall long-term trend for equities has been significantly positive.
So putting it all together then, the main takeaway seems to be, despite all the current nervousness, this extremely rare indicator, the Zweig Breadth Thrust, has flashed. And its history, while not a guarantee, is frankly perfect in terms of predicting positive market gains over the next 6 to 12 months.
That's the historical record, yes. It suggests a high probability, based purely on past occurrences, of a better market environment unfolding over the medium term.
Even if we need to buckle up for some continued bumps along the way.
Precisely. Expect volatility, but perhaps view it through a more optimistic medium-term lens suggested by this signal.
Okay, so here's a final thought for you, the listener, to maybe mull over. Given this pretty striking historical data from the Zweig Breadth Thrust, how might it influence your perspective on the market's current ups and downs? And maybe, how does it frame your thinking about your own long-term investment plan? Consider what solid companies at discounted prices could mean for your portfolio in light of this potential signal. Something to think about. Thanks for joining our deep dive today.